What's up, you guys? My name is Peter Claes and welcome to my channel. Today I want to cover a little bit on how to do a projection of your net worth going forward. We're also going to cover a little bit of compound interest and how that works. And in order to do that, I want to use it in Google Sheets, and I'm going to build a little bit of math and some data, some starting points, and maybe some graphs as well, so we can easily visualize what is going to happen with all the data that we're plugging in. So let's get started and let's dive inside of Google Sheets. So over here, we have Google Sheets. It's empty. I just named the thing compound projection. So how do you start with this? Well, the first thing that I want to do is let's go and visualize what compound interest kind of sort of looks like. So in order to do that, we need to say, let's start with a number. And here I'm going to start with $1,000. And then we're also going to need an interest rate. So how much of an interest rate can we give it? So we can say, well, this will be, let's start with something like 7%, right? So 0.07. And what will happen is every year, right, over here we'll put some time value in here. This will be our dollar amount, and then also this will be our interest rate. And then we can sort of say, okay, what is this going to look like at the end of the year, right? So this will be our beginning of the year versus end of year amount. And is it years, is it months? We can change our time eventually. But so what is going to happen? How can I add 7% to this? Well, in order to do that, we can either say multiply it by 1 times 0.07, or we can say over here, let's say this is equal to $1,000 multiplied by, and let's open the braces, 1 plus our interest rate, and that's it. Yeah, so 1070 over here. So what is the difference? Well, it's at $70. And so now if we continue doing that, I can use as our dollar amount is going to be whatever it was at the end of the year. So if we say over here equals, right, at the end of the year there. The interest rate, let's say this is going to be the same. So I can literally just say, all right, whatever you were over here. And we can use the same equation here as well, right? So this will be whatever B3 is, right, times 1.07, right? That's basically what's happening there. Cool. So as we can kind of see, if we just turn this into our formatting dollars, right? So then everything becomes dollars. And let's grab all of these values over here and just pull that down for, I don't know, 30 years, right? So here we're starting sort of year 2, technically not really year 2. We can say over here, let's start in year 1. And let's add 1 to the year. So let's take the previous year plus 1 year. And so let's just see, after this is 29 years, after 30 years, what has happened with our $1,000. All right, so as we can kind of see, every year, right, this thing kind of grows, right, and it changes based off of the interest rate. So if we have a 7%, this is kind of what the S&P returns after inflation is taken into account on average over long periods of time. Now that doesn't mean that the S&P goes up all the time. In terms of some years it might be negative, maybe negative 5%, negative 7%, negative 10%. But some years it's going to go higher than 7% up as well. So some years it might be higher, 10% up, 20% up, even, I think we've had a year, 2017 was pretty high, was about 30% up. So, but on average, right, over long periods of time, it'll be up 7% after inflation. Before inflation, it'll be closer to 9 to 10%. So, okay, what does that mean? Well, if we are in the first year and we invest $1,000 and we don't touch it anymore, right, and over here we can see end of year amount. After that 1 year, it'll turn into $1,070. So there will be the $70, right, that basically has compounded, right, and it's going to sort of keep doing that. So the 1,070 becomes the start amount for the next year, and then again 7% of that increases. So let's maybe also over here see the increase in the value, right, every time that we do this, right? So we can kind of take the difference value. That might be a useful one to sort of see as well. So we see the end of year amount minus the start of year amount, right? And so as we said, $70. And so here at the end, we're going to see that, right, that's now almost $500. So that's quite a difference. And we haven't even done anything else. And so this is really the magic of compounding. We're starting to sort of see how, that 7%, starts to become quite a large amount, right? After a while, after compounding. So also, whilst we're doing this, maybe let's make another sheet and visualize that in a graph. So over here, this sheet 1 is my data, and then sheet 3, we're going to make a graph. So I'm going to insert a chart, and let's go grab our data. So our data range over here is going to be our dollar amount, right? So we can see our dollar amount. Okay, let's see this. And so this curve that you see over here, that's that typical compounding curve, right? Right now, this represents 30 years time. And you can kind of see we go from $1,000 here at the beginning to over here, $7,000 at the end over 30 years when that money is invested. Okay, now the thing is, this is a little bit, I wouldn't say unrealistic, but it's a little unrealistic in the sense that it's it's a clean 7%. It's a clean $1,000. There's no ups and downs. There's also no contributions being added to this. So it would probably be a good idea if we kind of say, okay, what if we start adding more money to this, right? And then instead of doing it on a yearly basis, what if we expand that out on a monthly basis so that you can kind of project it more in accordance to your savings, your salary, maybe your expenses as well. Maybe we can say, okay, what about what is 2% of this amount in terms of 2 or 3% in dividend income? If eventually later on you may want to live off of the dividends, what would that represent? So those are useful things. So let's expand that. Let's see if we can just duplicate this. So I'm going to duplicate this sheet. We can leave this curve here. That's fine. And this copy, let's rename it. And let's say this will be just sheet 2, I suppose. Yeah. All right, let's do that. All right, so what I want to do is I basically say, okay, the interest rate, that's still going to be the same, but let's do this dollar amount on a monthly basis. So the time over here will be time in months, whereas before we'll have the time in years, right? So that's a little bit of a difference, first of all. And so then now that we know, okay, here 12 months in, that's going to be our first year, and so on. So maybe I'll insert another column here, insert a column, so we know also the time in years, right? And we'll figure out a way, perhaps later, over here that this is going to be year 1, and then as soon as we hit 13, this will be eventually year 2. We'll figure that out. I don't know. That's we don't really worry about that now. So it'll basically just be divided by 12 and then clamped or rounded or something like that. So cool. Dollar amount starting $1,000. So how much can you save per month, right? So I'm going to insert over here. This will be addition, right? So how much additional savings, right? So how much can we add to the portfolio every month? Well, let's put in a number. Let's say we're going to start with $1,000, sure. And initially, let's just say I can save $100 every month, right? Something like that. So eventually we can tweak these values, and we can do that when we duplicate the sheet so that we can have alternative visions as well. But let's start with this. And so at the end of the month, right, instead of end of year amount, this will be end of month amount. So this interest is no longer really truly going to be 0.07, right? Because let's see how we do this. I can open up and put in another column here, insert one to the left, and this will be my interest. I basically need another line. I could say, let's do this. Let's open this up, one above, and here this will be my interest rate, but yearly, rate yearly. And so my yearly interest rate can still be 0.07. That can remain. But what is going to be my interest rate on a monthly basis so that this can actually compound monthly, right? So, well, easy enough. We basically just need to take our yearly and divide it by 12, right? So basically take our yearly and divide it by 12. And so this number, the 0.005, right, is going to be my monthly rate. So, okay, let's say equals, right, our monthly rate. Right, it's a little bit hard to see, so let's see if I can, no, the other way. I just want to see maybe up to 2 periods. Let's see if we can do a number, right? So, well, this isn't that great either. 06, 05. All right, so about four periods, 4 positions after the period, I can kind of sort of see how much that interest rate is. Okay, fine. This all still works, right? Over here we can kind of see, okay, this is going to return now $5 after. Now the end of month amount isn't correct yet because we haven't added our savings in there, additional savings. We basically need to say this is equal to, right? If we look at it, C3 times whatever, right? But actually I'm going to say, do we save it at the beginning of the month or at the end of the month? Let's say we save it at the beginning of the month, just to make it a little bit easier. So in order to do that, we're going to open this up, C3 plus our savings. Let's add the savings in there, and then times whatever interest that we get that month, right? So now we can kind of see, we start with 1,000, we save 100, so that becomes 1,100. So, and then finally, we also add our interest to this. So if we really want to break this down a little bit more, it's a good idea to do that, right? So that you can kind of see, you know, just the interest amount, right? So the interest, if I can spell it, interest gains, right? So here, this would be just the gains from the interest, and that's really this amount, but minus, actually, let's see, this, just not the 1 here. F3 is fine, yeah. All right, so this is just the interest gains. So that basically means take, you know, the $1,000 plus the $100 savings, and then multiply it by our interest rate, our monthly rate, and then here we get the gains out of this. Now, why do I bother breaking this up? And also, it looks like I've messed up my formatting. So let's just copy the formatting. If I could do that, let's do that. Control copy, control paste relative. Where is that? Paste special, paste format here. Yeah, and it's just so that the letters and all that stuff is the same. The fonts are the same. All right, anyway, so if we pull this through, right, and let's do this for everything now. So here we could actually say, if we want to break this down, this is the same thing, or we can just say, go and add, because we've already broken this out, right? Go and add this 1 plus whatever, plus our gains, right? So this might be easier in terms of the calculation, right? Oops, I made a little mistake here. I'm just going to add all of them up. So this one will be, this is equal to our $1,000 plus our additional savings plus our interest gains, right? So cool. What about this? What's going on here? This is again that difference. We already kind of sort of have that difference, right? We already have our interest gains, so don't necessarily need to do this. We'll wipe this in a moment. Okay, so next, this will still need to reference our end of the month amount. So that's the same. How much savings do we have? Well, currently it's a fixed amount of $100 savings. Eventually, when we start to make more money, right, maybe we can save a little bit more money and we can kind of continue with this, you know, calculation. So now let's pull down our interest gains as well for a little bit so we can see that, and also our end of the month amount as well. So, oops, I just want to make sure that I grab the expression and that the equation updates as well. Okay, cool. Let's see what else. So currently we're about, see in time, we're about 2 months in. So, you know, not even that far in, 2 years in, I should say. So let's, you know, open it up a little bit so we can kind of do word wrap on this as well. Where is that thing? Here, this one. So, all right, cool, nice. So this allows me to sort of see my numbers a little bit better. So okay, that's that. Next, I want to say here my years, right? So my years is equal to this 13 divided by 12, and I also want to see if I can clamp this to an integer. Then if I can do that here, or maybe we can put it at date time ourselves. Maybe I can put a clamp around it or something like that. We'll see. Or a round or something like that. They must have round functions here as well. So let's say integer maybe. Yep, rounds down to the nearest integer. Perfect. Cool. So let's watch that. Plus 1. Let's add 1 to it. Plus 1. So year 1. Yeah, great. So year 1, year 2, and so on. So let's see how many years we can kind of expand this out onto. Let's maybe grab all of this, all these values here, and let's just expand all of this down for, I don't know how many years we want to model. Let's say 200 lines. Let's see how much we've got here till about there, right? All right, so that's 17 years currently, about 200 months-ish. And let's see, in 17 years time, we're saving $100. How much do we have, right? Now, this is a little bit annoying as well, in the sense that I should have probably put in the $100 myself and then just say $100 equals to whatever the previous was. Same thing like here, that's all fine. Cool. All right, so let's keep going. $100 here. Let's say over time, I want to save a little bit more. So $100 is not that much. What if we can save maybe $200, right? So every month, right? What is that going to look like? All right, so keep going. I'm going to just expand this out a little bit further, right? So you can just sort of see, I don't know, maybe 500 rows, or yeah, 400. Let's see how far we're at. All right, so 34 years into the future. So basically, if you start at, I don't know, 25 years old, and this will get you to age 60, right? So maybe you can put in an age in there as well. So let's see, the interest yearly, we don't really need this anymore. The monthly, we can kind of cramp that down a little bit too. And so now I can kind of sort of see here at the bottom, right, as we kind of keep going, right? Notice after 34 years, right, this is starting to become quite a large amount. This is starting to, $170,000. So, that's not bad. That's good amount of money. Okay, so next what I want to do is let's shove this into a graph as well. So here, let's add another sheet and let's shove that into a graph. So let's insert another graph. Let's go grab our data range, and here I want to go grab all of C till C400 and whatever, right? So here we can kind of start C, just roll it all the way down. Takes a little bit of time, but there we go. All right, cool. So there we can kind of sort of see, again, that same compound interest curve. And so we started really small, right? So something like $1,000, and we ended up after about 30 years with $170,000. Now, the cool thing is you can kind of keep modeling this and keep changing this, right? So let's say one more thing that might be useful to you is maybe this interest rate, right? We can split that out in terms of dividend income, right? Now, I like thinking about dividend income. It's not necessarily the most tax advantaged way of investing, but it is eventually a nice way to see how much you could withdraw from this. So if we were to say dividend income, now if we have a dividend income, dividend with a D, dividend income, we also need to know the dividend withdrawal rate, right? So, or rather the percentage of your yield, right? So basically here, same thing again, dividend yield. Now, annually versus monthly, same thing here. So dividend yield annually. And let's do dividend yield monthly. Now again, these are projections and averages. Also kind of want to make sure we are wrapping again this thing up. So dividend income, maybe this should really go here. Let's remove that column. All right, so my dividend yield annually, let's say something, it's gonna be pretty low. It's gonna be something like 0.25, right? In terms of like, it's not very high. You probably will need to eventually sell some shares and all that, but even so, it's nice to sort of be able to see that. So what is my monthly? That same number divided by 12, right? And then dividend income, well, we're gonna figure that out. So here, dividend yield, that's all fine. You can just map that. If you go after different stocks, you can find it out as well. So what does that mean? Dividend income? Well, let's see. We're going to grab our end of the month amount, right? That's our end of the month amount. And basically here, our end of the month amount multiplied by our dividend yield monthly. And so this is kind of fun to see, right? Whereby if we invest about $1,000, maybe every month we're going to get about 2,500. This dividend income is our monthly, right? Now, what if we were to do this yearly, right? So here we could also say, what is our yearly gonna be? So dividend, let's copy this, yearly, well, you can either add them all up, right? So you can literally just grab all of these and auto sum them and add them all up. Maybe that's not a bad way of doing it. Or you can just sort of fake it a little bit in the sense that you can kind of say, all right, go grab our numbers and multiply it, right, by our annual. Now, if I've kind of locked in my annual here, so I just kind of want to make sure that this doesn't move as I expand out my my rows. So we're going to lock that in with $signs. And so now as we kind of pull this down, first I will pull this down, right? So should have probably pulled both of them down, whatever. So let's just keep this going, right? It's basically the same number anyway. Let's grab all three of them, probably a better idea. And let's just pull all of them down. So for however many rows and columns I've got, right, we can kind of see this. So the reason why I do it like this is because we can actually do overrides, right? So we can basically say, what if over here I want to save $200 rather than $100? So then we can kind of start modifying different bits of this. Now this is still all in one spreadsheet, but let's see. In year one, we have dividend income of a 30. Rather, I should say in month one. And then let's also try and squeeze that in a little bit, right? So that we just see everything in one range, right? So we can see everything together. All right, cool. So as we kind of keep going with this, right, we can see monthly dividend income, right? It's going to start going up. This is your passive income. And then here, 34, right? So 34 years, so, you know, about 34 years in, we have 369 monthly dividend income that's coming in on a portfolio of about 170,000, right? So that means we make about 4,000 annual, right? Now, obviously, dividend income is only a portion of it, so it's a small amount, right? So we also would probably need to sell some shares and things like that. Again, let's maybe put this into another graph. So here, let's make a new sheet and let's say insert this chart, but it's all the same chart in the sense that you're basically going to see that same compound curve happening, right? So here on our dividend income, as we go grab it, we can see our yearly or we can see our monthly. Let's just use the monthly. Because ultimately, if you kind of start knowing what are your monthly expenses, right? Is it kind of like, is it based off of your rent and things like that, right? Then we can kind of see here. So we start small, right? So we start with like $2 monthly, almost nothing. But then as we kind of contribute more and more and more, right? Then we can kind of see this is going to go and add to quite a bit. Like here at the end, $300. Remember, we are only saving $200 a month right now, and our dividend income is $360. So now our dividend income is more than how much we actually save every month. That's great. So let's play with the numbers a little bit, just for fun, right? So if we kind of look at this, right, and just say, all right, what if instead of $200 a month, can you save $300 a month? You know, what kind of impact is that going to have? Also, maybe, I don't know if I can branch off or see that, but it'd be kind of nice to sort of modify these numbers and then just see what the results are. So maybe here, I'm just going to grab that bottom value. So we can kind of sort of see end value, right? So we can kind of sort of see at the top immediately what that is going to be. So I'm going to go equals, and let's go see what my end value is here after a certain amount of time, right? So actually, technically, this is my end value, right? And then also, let's see end dividend value, right? And we can just plug that underneath it as well. So these are just going to be some summations, some values. So end dividend monthly. So this is going to be equal to whatever my last number is over here, this one. And finally, let's do end dividend yearly as well. End dividend yearly. So this is obviously modeled very kind of, I would say aggressively. It's pretty defensively. Here, oops, which cell is that? 409L. So we can just put that in there. So let's see, equals L409. There we go. All right, so this is my yearly dividend at the end. This is my end value of my portfolio, and this is my monthly dividend, right? So now let's play with the numbers. What if we say Instead of 200, we save double that, 400. Right, so these numbers now, oh, it looks like it didn't quite go through here. Made a little mistake. Anyway, just extending that function. All right, great, boom. So now it's all 400. So now our portfolio is at 600,000, so $500,000 pretty much. And our dividends here, right, our end value, let's maybe bold them a little bit because these are kind of useful to see. Right, so my end value here is $600,000 portfolio if we save $400 a month, starting with $1,000, right? And so you can kind of see how quickly that goes up. Now, our graphs are pretty much the same, but obviously our numbers are different, right? We could map our time values in the other axis. I mean, it already kind of implies that, but we haven't labeled it. So, and then same for our dividends. So we can kind of see, again, we started off with a small amount here at the beginning, and we end up with something like 1,400 every month. So yeah, that's pretty great. I mean, this is kind of how you can kind of gain an understanding of how this works. So I don't know how much, you know, if you really crank this up, right? So 500 a month, right? Can you save 500 a month? Maybe, yeah, maybe. So then you end up after 30 years with about, or 34 years, with about 20,000. So here maybe we can also say end years currently, right? How many years is this that we currently have? And this will be time months, so that'll be A. And what was the thing? It was 409, I believe. A 409, something like that. So 34 years, right? So was it? Yeah, 409. So this is our period. This is our time value right now. So eventually, maybe we can automate this a little bit more so that it automatically detects all that. But this is how you build a basic projection sheet. Now, the cool thing is, I would say one more sheet that you can do, right? We don't necessarily want to do that right now, but is a new sheet. And here you track your actual value of your actual portfolio so that you can compare your projection against your actual portfolio. And you can even say, I'm just going to duplicate all of this data, but not necessarily put in the expressions, right? I mean, obviously the other expressions maybe, but not the accumulation expressions. And that way you can kind of compare your theoretical projection against your actual value that your portfolio is tracking at. So hopefully you like this. If you do, please like and subscribe. Also hit that notification bell for the YouTube algorithm. And I look forward to making more of these kind of videos. Yeah, I'll see you in the next video. Cheers. Bye.